Welcome to the Founders Forum podcast, brought to you by the Foxwell Founders, where we interview some of the hottest minds in D2C right now and deep dive on their area of expertise. Everyone that we interview here is a cherished member of our Foxwell Founders community of over 550 advertisers worldwide and are at the cutting edge of what is working right now. I hope you enjoy this, and if you have any questions, feel free to let me know. Andrew at Foxwell Digital. And now let's get stuck into this week's episode. Here are Edwin and Tris, our hosts.
Three best ways that we've ever seen to deal with this is
it's one of the things that's working really, really well for our agency right now.
Question of the week, right?
He's going to spill all the tea on TikTok for us. What is the oh wow strategy of the moment? If it's working, if it ain't broke, don't fix it.
Who buys it even at that time, right? Hi guys, welcome to Foxwell Founders Podcast. I'm Tris.
I'm Edwin.
And we have here today Abir from Up Accounting, which is an e-commerce accounting firm. So Abir has previously run some e-commerce brands like Exoprotein, and now he runs an agency. So he's able to bring us a really cross-functional perspective of how to do accountancy for e-commerce brands and agencies and everyone alike, and kind of what are the real numbers we need to be looking at. So Edwin, kick us off.
So Tris said it. I want to hear it. Tell me, what are the real numbers that we need to be focusing on when you're looking at an e-commerce company? What are the key metrics when they come to you? Those are the first digits that you're crunching.
That's a great question. So obviously there are a lot of numbers that we work with. I mean, we're accountants, that's what we like to look at. So we have our spreadsheets with tons of numbers, but I think the ones that are perhaps less commonly looked at by brand founders themselves, because like revenue is important. I'm going to look at revenue, but everybody does. So that's not really revolutionary. Yeah. I'd say the big ones are one of the biggest ones is contribution margin. Now, I'm glad that in the last year or so, there's been a lot more discussion around that concept amongst agencies, brand founders as well. It has kind of risen up the ranks in terms of the general lexicon amongst DTC folk.
Yeah.
Give us a breakdown on contribution margin. Like how are you actually calculating that?
Yeah, absolutely. So a lot of people have started to understand it, but the simplest way to think of it is that it's basically the money left over from all the revenue that you generate, such that you're taking your revenue, deducting all of your variable expenses, and what's left is your contribution margin. So variable expenses, there's a little bit of nuance to this, but the simplest way to think of it, it's those expenses that scale more or less directly with increases in revenue. So your inventory expenses, shipping expenses, advertising expenses, transaction fees, stuff like that. Those are the most common ones. And the reason it's such a useful number, yeah, go ahead.
Employees, are we taking out employee salaries as well, or no?
Typically, no. So anything that would be what we call fixed expenses, we don't include in that number, because those are the ones that this is the simplest way to think of it. If I were to double my revenue overnight, just like that, would that expense change? Employees typically don't. Now, you may argue on a longer term basis that my customer service employee costs will go up, and there is some element of truth to that. So in reality, it's not binary. It's not perfectly fixed or perfectly variable. Things kind of exist on a spectrum. But for the purposes of most kind of brand founders kind of doing their math on a day-to-day basis, employees usually keep out of it because it doesn't really scale instantly.
So you're not bringing in the cost of toilet paper and stuff like that. You're just bringing in what will scale as you scale your sales.
That's exactly
You're talking ads, you're talking inventory, shipping. Does that come into it as well?
Typically, yeah. So if you're shipping twice as many goods out, your shipping expenses usually will more or less correlate linearly with that. So you would include that.
Okay. So I mean, years gone by, people were talking about a ROAS or advertising ROAS. They got MER, and now this is obviously the next one. We're getting closer to that. How much money I got left kind of number. Yeah. Is there an evolution of this, or is that kind of this is the number that people should be looking at really to kind of guide any decisions? Is it making me money or not?
That's a great question. So what's nice is that because people have been in the last couple of years focused a lot more on the financial side of the business, which I think is extremely important. I'm very excited about it, and people have kind of learned about the concept of contribution margin. The risk is that you may swing too hard in that direction, and then people think that it is truly the one number that matters. And it is absolutely a very important one. However, it is not the one number that matters. If I had to pick one, it would be operating cash flow. Because at the end of the day, it doesn't matter how much contribution margin you have. It doesn't matter how much net profit you have. it really just comes down to, do you have cash flow being generated from the business that you have, or how much? If you're, have it running off a lot of debt or venture capital funding, then you can kind of run on a negative basis. But at the end of the day, the cash flow is what allows your business to be alive.
Makes sense. Makes a ton of sense.
Yeah, the reason contribution margin in particular is so specifically emphasized is because of the fact that it is one of those numbers that's extremely relevant on a day-to-day basis from a scaling perspective, and it's also one that is a lot more relevant to marketers. And a lot of the people in these conversations are marketers, so a lot of times that's the one that they can control. So a marketer is not necessarily going to be the one pulling the levers on how much do you pay on rent, how much do you pay for your front office staff or your HR department, stuff like that. So this, to an extent, kind of isolates the things that are within the marketer's control, and that's why it's such a fun number to focus on, and it is important. But for a founder, cash flow is what matters.
Gotcha.
So contribution margin, what is a healthy contribution margin, based on different size companies have different, healthy levels of contribution margin.
Yeah.
So give us sort of like a general rule of thumb.
That's a great question. So I would say that a healthy contribution margin, there is complexity to this, but I'll try to simplify as much as possible. A healthy contribution margin generally is enough to sustain your business strategy. So if you are, for example, scaling very aggressively, you can run at, say, a $0 contribution margin. So you're not making any money from the scale. That means that the fixed expenses have to be paid out of pocket. So you're probably burning cash to cover your fixed expenses. Now, if you have venture capital funding, okay, you can do that. That's a viable strategy. If you're bootstrapping, then your contribution margin should be high enough to generate enough cash flow to cover your fixed expenses, give you some sort of profit, and also accumulate enough cash so that the next time you have to place a big inventory order, you can afford to do it. So the right number does depend a little bit on strategy. The shortest rule of thumb I give you is that if you have reached a scale where your recurring customer revenue is enough to cover your fixed expenses, then you can basically spend as much as you want on new customer acquisition. So essentially, you want to break even on the new customer acquisition. So your new customer contribution margin can be a zero. Means you're not losing any money for acquiring those customers, and your returning customer contribution margin is covering all your fixed expenses, so your net profit is zero. So you're not losing money, you're just roughly breaking even. That's the most aggressive you can get, but it is a tricky dance to play because, as we all know, meta doesn't work perfectly the way we want to all the time.
Talk to us in October when things start to get a bit shaky before Black Friday. Right.
As a side note, I was at the gym and I was talking with one of the other guys at the gym who was on the sled thing, and dude was dying. And it turns out, we were joking around, and it turns out that he's a meta engineer. He's a high up in the. And then we were joking, and I was like, "How are you gonna feel in October?" And he's probably worse than this.
Yeah. I'm sure with the brands though you're working with, right, in October, this is the thing, right? So that's obviously the most aggressive. Why? Because we say kind of, when we're buying with meta ads, sometimes we kind of say in that instance, look, you got to accept a lower return at that point to get a better return in November. We're coming into Black Friday now. We're all talking about Christmas. I mean, it's the middle of the summer, but we're talking about Christmas. What kind of advice are you giving to brand owners specifically on how to manage that? Not just cash flow, but actually cash in the bank. How much do they need to have to survive that? We'll call it winter, but ahead of the summer.
Yeah, it's a great question. It really does come down to a certain extent to the brand's strategy with respect to how aggressively they want to acquire customers during that time period. So while I think as a general rule of thumb, this is not often recommended as an approach because of the whole philosophy of cheap customers don't really give you a great LTV. But let's say for the brands who think they can pull that strategy off, oftentimes what they'll do is that they're happy to go, a little bit maybe cash flow negative, maybe be a little bit more aggressive on their acquisition during the Black Friday or BFCM season because they know that if they can retain those customers long term, it's worth it for them. So if that makes sense for them, that's fine. But I think that the broader sort of advice would be whatever that strategy you have that you want to deploy during that BFCM season, make sure that you have an adequate amount of cash to be able to kind of fund it. But more importantly, make sure that you're planning for the purchasing that's going to have to happen 1, 2, 3 months ahead of BFCM so that you don't run out of stock. That's the worst thing, that if you're having a killer BFCM and then you run out of inventory, you don't want to have that situation. So, and on the flip side, you also don't want to over-order inventory and then have a horrible BFCM and then just kind of sit there on stock that you can't move. So that planning needs to happen well in advance, obviously. And even for that purchase to be placed, you need to make sure that you have enough cash. So be conscientious of the cash reserves you need to accumulate during, May, June, July, so that if you have to place your orders in August and September to make sure that everything's there and ready for BFCM, you're ready. So and it depends on the manufacturing kind of supply chain for any particular brand and how much lead time they have, but that is why, on the one hand, when a marketer talks about planning for BFCM in April, that might seem like, okay, I mean, some people maybe get excited about that, but some people, that's a little bit early. Like, I can set up my campaigns, closer to August, September, or start filling up my funnel, whatever. But when it comes to the operational side and inventory and cash flow, you do need to start planning quite a while in advance.
Yeah. And so with the focus on BFCM coming up and kind of, placing that order with marketing agencies and people running media, we can do forecasts. We can say, look, this is what's selling. This is what sold before. This is the CPMs that we're expecting. All this kind of stuff. We got a lot of media detail that will give us. What kind of financial stuff are you looking at from, say I'm a shoe brand and I'm selling, 50 SKUs. What kind of stuff am I looking at from a financial standpoint to go, where do I need to be at? Because I understand it from media, and a lot of people will understand it from a media standpoint, but financially, there must be some sort of indicators that I need to hit to know we're going to have a good BFCM.
Yeah, absolutely. So I'd say that, not to oversimplify, but I think this does hold true for a lot of brands. You can build a good financial model that's pretty thorough with really 3 major components. The first one is your sales, because that decreases your inventory and brings in cash. The second one is your cash forecast, which is decreased when you make inventory purchases and increased by sales that come in. And the third one is your inventory, which is decreased when you make sales, and you have to make sure you have enough for those sales to happen, and then obviously enough cash to make the purchases. That trifecta to me is what a brand, if they have that and they can do a good job of it, they can get a pretty robust forecast and good visibility into the future. But obviously the hardest part of that is the revenue side. That is the most tricky thing to be able to forecast. So ultimately, if, for example, the agency or the marketing team, CMO, whatever, if they're able to, just for the sake of the argument, come up with a very robust and very accurate theoretical projection for what sales would be, the rest is just math. And it's reasonably easy to be able to figure out, okay, based on that, how much cash will I generate? How much inventory do I need? How much cash do I need to place those orders, assuming my supply chain functions the way it's meant to? So it's kind of simple from there. Really, the hardest thing is the revenue forecast.
Gotcha.
So I'm sure that you've gotten this question before, but there are people that they're trying to revenue forecast for Black Friday, right, for the holiday. And so have you found, of course, not 100% accurate, but generally acceptable forecasting formula for that?
It's I'm going to say it's nearly impossible to do a good job of this because of the unknowns. But what I will say is that there are factors that help and factors that hurt. So, for example, if you are heavily reliant on just a single sales channel and a single marketing channel, and that channel happens to be Meta, then it can be a little bit more, challenging to kind of predict that. For example, on the other hand, if you rely heavily on Google, where search volumes are a little bit more easy to predict, there's a little bit more visibility, a little bit more seasonal stability or consistency, then it might be a little bit easier. Something like Amazon as well generally can be a little bit easier, assuming, of course, you don't get your listings shut down or whatever. If you work on the wholesale front, then you can benefit from their purchasing expectations. So they'll set their revenue expectations. They'll tell you what they're going to buy, and they're usually, whether they're able to sell it is their problem, but at least they can set those expectations. So it'll vary a bit on that. But in terms of methodologies, I mean, because a lot of brands rely so heavily on Meta, it is typically kind of difficult to predict that. So if you have historical data, you have a rough sense or a level of confidence with respect to, like, in theory, or in most months, you're able to more or less predict with a reasonable amount of accuracy, like what your ROAS is going to be, what sort of spend levels you're going to be able to hit, because you have a good machine in terms of, like, generating new creative. Best case scenario, you have a creative that pops off and revenue skyrockets. Worst case, maybe it slows down a little bit, but nothing too crazy. You should be in a decent situation. And if you live in the world of the cost caps crowd, where, for example, at the end of the day, I don't really care because I'll always be profitable because of cost caps, that's great, as long as you don't have very heavy fixed expenses. Because fixed expenses mean that you need to generate a certain amount of volume. It doesn't, if you're a pure drop shipping play, let's just say for argument, you have no fixed expenses, well then yeah, you can't not be profitable if you run cost caps, in theory. So there are all these levers to consider in that. But when I try to work with a brand on the forecasting side, the simple approach is we take historical data, we make some sort of assumptions about the future, and we go base case, low case, best case scenario. So if you have that kind of 3 scenario setup, you kind of get a rough range of where you might fall. And if you plan for the worst and the best at the same time, then hopefully you're able to do a decent job.
Makes sense. So shifting gears a small bit. So we're talking a lot about kind of people planning kind of best case scenario for Black Friday and what they should do. I'm a brand, I've launched and I've done very well. Things have started to take off and I'm like, holy shit, where's all this money coming from? Getting stacks of hundreds and I'm putting it on my Instagram and people like this. Like, where am I going next? For example, you know, owners at that stage, I mean, obviously that's not the common case, but like owners, you know, are looking for the right numbers. You know, what do we need to get? What kind of numbers do I need to get together and make sure that I'm saving enough money for, you know, the IRS looking for their money. We're looking for anyone else. Kind of like there's a lot of stuff that I need to start thinking about. But what are the things that you say to a starting business or somebody who's starting to see success, but there's pitfalls coming and they need to be careful?
Yeah, it's a great question. So there's a few considerations there. Firstly, I'd say is what sort of kind of I guess goals you have for the brand in general. Are you trying to scale it to be able to hit an exit? Are you trying to run it as a lifestyle business? Are you in a situation where you've been bootstrapping and eating ramen for the past 2 years and you need to like live life a little bit, or just kind of get back to a normal, living comfort level? So depending on those, you're going to determine, you know, how much you want to reinvest in the business versus kind of take out of it, if you will. But regardless of that, the other major consideration is how reasonably you can expect the benefits that you've seen in the past to continue at a level into the future. So ultimately, it really does come down to forecasting. Maybe you pop off. I'll give you a simple example. Say a brand that goes on Shark Tank. They go on Shark Tank. They have a massive spike in revenue. Their sales are crushing, and everything's going great for the first couple of months. They'll get a couple of spikes in the future when Shark Tank reposts their video on a different social or whatever. So you're going to get spikes. But realistically, that 3-month period right after the episode goes live is not indicative of the next 3 months or the 3 months after that. So it really does come down to being able to forecast how things are going to look a little bit into the future and then say, okay, once this feast phase is over, are we going to be in a famine? Are we going to be in a position where we've built enough clout, enough traction that we can now obviously come down, but at a bit more of a stable, healthy, sustainable level? What can we expect going forward? As a broad general rule, though, I'm perhaps a little bit more conservative. Maybe it's the accountant in me, but I tell brands, sit on a pile of cash so that if you have that worst case scenario in your forecast happen for, say, 6 months, you're not in a situation where you have to take really bad debt or investment that are not favorable terms.
How big is that pile of cash that they need to be sitting on? How big?
It depends on the size of the business, right? So, kind of rough rule of thumb, imagine you have shitty results for 6 months and you don't want to run out of cash.
So basically fixed costs 6 months. Is that it?
Yeah, that's pretty reasonable, yeah.
Sounds like a lot, but also then makes sense. So your fixed costs at 6 months is like that, forget the contribution margin or anything like that. This is what you need to, or is a runway, isn't it? Right? It's what your runway actually is.
Exactly.
And where are you keeping that? Are you keeping that in a savings scheme? Are you keeping that like in a current account? Like what are you doing? A checking
Depends
account?
on what elements you have available. Probably a little bit of a mix. So you want to keep some chunk of it obviously like fully liquid in your checking account. But if you have a good high yield savings account, you can put chunk there. And if you're feeling relatively good about it, you can put a chunk of it also into bonds or something. So really it depends on
Crypto.
what not crypto. But yeah, it really comes down to what kind of financial instruments are available to the brand depending on what geography they're in.
Yeah,
And
yeah.
so tell me, like, you've been around the block. You've seen a lot of different brands. They go up, they go down. Spill the tea. Tell us, what are some of the things that you've seen brand owners do that you're like, that is a trap? Tell us, what is the trap? Spill the tea.
That's a great question. I mean, I've seen a lot of really poor decisions that make me wonder why I work with, why I'm a service business and I don't just do this myself. It really, like, I've seen a lot of different ones. I wouldn't say that there are some very common ones, but you'll have instances where, for example, I've worked with brands where they have had, ads pop off, really, really good performance start to happen, and they've, for example, just had this sort of like deeply ingrained thought about very rigid budgeting processes, oftentimes coming from someone they hired from a very large corporation who only knows how to run a business one particular way, and that doesn't really translate well into small brands, because I've seen that mistake often. And so then, for example, they're just not really taking advantage of an opportunity when it's there. On the other hand, a very common one is that people just kind of get shiny object syndrome and then just run around and try all these different things, kind of hoping that they'll find a weird, combination of magic words that will unlock a scale that nobody else has reached, but that often doesn't happen as well. Mm-hmm. But in broader terms, I'd say the more common error is that when they do have those feast phases where things go well, they maybe lose a little bit of the financial discipline, and they overinvest on the fixed expense side. So, for example, then they'll start making very expensive hires. They'll start, they'll get rent on a big office type of thing. They'll, maybe start taking on these big software expenses with like 12-month contracts. So basically, they put themselves in a position where they're less nimble, they're less agile, and ultimately, you want to be in a situation where as many of your expenses are variable as possible, so you are able to always move with the ebbs and flows. In theory, as you scale, and if stability is there, you can have a higher net operating profit and be more economical by shifting over to more fixed expenses. Because in essence, you're paying for the flexibility of variable expenses with a higher cost, essentially. So the example would be a simple example. It can be a lot cheaper to have your own warehouse once you're at the scale to warrant having your own warehouse, because you're paying rent at a much lower rate. It's your own systems, your own people, and you're not paying the 3PL their margin. When you're at a smaller size and you're not sure if you're going to be big enough to warrant a warehouse, it's just a foolish thing to lock yourself into. So I think that once brands start to see a little bit of success, they just kind of think like, oh, wow, I made it. I'm the greatest. And they don't realize that it's probably going to go down after some time, and they kind of lock themselves into expenses that are probably going to hurt them down the road.
It's very similar with agency, right? So do I hire a marketer in-house, or do I give it to an agency? And the agency is a variable cost because, especially if they start charging on percent of spend, it goes up and down. Whereas if you have a fixed cost of a couple $100,000, you've got a white elephant sitting there for you, and whatever color elephant it is, it's still expensive. It's something you gotta watch out for. That's massively interesting. Just going back to that, then, I mean, if you're looking at those, and again, you're not necessarily your people going through Feast and everything else like that, and Shopify is probably the worst for this. But you get the app and you hear ching ching, and if you got an Apple Watch, tits to that, like your wrist is falling off because it keeps fucking vibrating. How often are you checking the actual numbers? How often should they be looking at it going, this makes a ton of sense to be looking at this on a weekly basis, or let's not look at this for a month because we just need to focus on the doing and then go and come back to it? When should we be looking at this?
That's a good question. So I'll answer from two sides. The way that we work with brands, which then kind of reflects into what I would recommend to a brand founder to do as well. So for us, it'll depend obviously on the size and complexity of the brand, but oftentimes we'll try to build out dashboards for them so that they're able to check on some of those key metrics like revenue, cash flow, stuff like that on a daily basis. And then usually we'll do weekly check-ins for things like AR, AP. So if they do sell wholesale, just being able to check on their invoices, AP to be able to have a sense of when they have to pay their vendors. And also if we're running cash flow projections for them, we check on those on a weekly basis. And then on a monthly basis, we kind of do that holistic business review, look at the previous month, year over year, month over month performance and stuff like that. And if we need to make tweaks to the model, we do that at that phase as well. What I recommend for founders is very similar. Generally, check your cash every day, just because looking at your bank account, even though you're not really going to do much of that information, I think it does develop a very good intuitive sense of like what are the ins and outs of your bank account, and just to be able to kind of develop intuition, for lack of a better term. Every day. Just look at your bank account to be knowing what's going in and out. It'll take 2 minutes, and it'll also let you feel a little bit of that important stress to know how things are going. So really, it's to be able to just develop that intuition.
Bro, imagine like hitting that Face ID every day when you're in a push. Like that will scare you.
Yeah, 100%.
I've been there.
So check the cash every day. Obviously check your revenue every day as well, but I'm sure most people are doing that. AR and AP, try to check it weekly. So that way you have a sense of like, okay, I know what bills I need to push next week, the week after. And if someone's not paying you, if you have wholesale customers, you know who to follow up with. Like, don't let that drag, because it also just develops a bad habit with the customers, thinking they can get away with it. So the AR, AP on a weekly basis, and it's good to go through your transactions as well. If you can go through your credit card statement and categorize in your accounting software, or look at the data that your bookkeeper is providing you on a weekly basis to see where the expenses are going, that's also helpful. So a lot of it in theory, if everything's running stably, you can also look at things once a year. But the more frequently that you look at things, the better an intuitive sense you start to develop of how things are ebbing and flowing. And so that's why I recommend the more frequent, the better. But at a minimum, just again, to be pragmatic, because not everybody has the time nor the patience to look at that kind of data, do it monthly.
Yeah, makes sense.
So, okay, so then going to that then, so founders, they're inherently busy people. Sometimes, like, you need to calculate the contribution margin, but they got things everywhere. How do you just do sort of rough back of the napkin thing without having them pull up like an old P&L sheet, basically?
Yeah, it's a great question. So what I recommend is that you develop these sort of like simple math equations, if you will, to be able to determine what your contribution margin will be for a given revenue and ad spend. So essentially, it's just the math from your ROAS. And so I have a whole spreadsheet that I built out for this. I shared it in the past. Like, people were quite fond of it, so I can give it to you guys as well if you want to put it in the notes to the episode.
We'll put it in the show notes. Yeah.
Yeah. But the benefit or the approach there that keeps it simple is that essentially what you're going to do is attribute every one of your variable expenses as a percentage. So, for example, my inventory costs are 25% of my revenue. My discounts are typically 5%. My refunds are 2%. My merchant account fees are 3%. My shipping expenses are 6%, whatever they are. And so assuming those percentages are relatively consistent, which, again, if you take a good enough average and there's not a crazy amount of volatility in the business, it should be good for napkin math. So if you keep those percentages, then it's really just a question of, depending on what my revenue is and what my ROAS is, I know what my contribution margin should be.
Makes sense. Makes a ton of sense, because then you can literally just stick it in. You can work out, okay, this is what my AOV needs to be. This is what my LTV. So that really helps, I suppose, for somebody to get in and just kind of quickly go, okay, I need to know these numbers now. So tell me this, when you're talking more LTV versus CAC, because obviously that's been a big kind of in vogue for quite a while. People talking about how do we acquire new customers, how do we make more money from them. That's the mantra. How much are you saying to people it's okay to not be first purchase profitable, but you know you're going to get your money back in 30, 60 days time? Like, how lenient can somebody be? What's the most, outrageous where you've seen someone try to get back in a year's time? Is it like, where's the market at right now?
I'd say most brands that I work with try to target first order break even. Some of the more conservative ones try to make money on that first order, but ultimately it really does come down to a question of how much confidence you have in your retention data, and that really comes down to how much data you have to a certain extent, but also strategy as well. So some brands that I've worked with, for example, have tried to implement the subscription approach with their products, and obviously there's varying amount of success. That's like the holy grail of e-commerce, but not every product is meant for a subscription, but some brands have actually been able to do a good job, like shift a significant amount of revenue, like go from 5% to 50% subscription revenue.
Whoa.
And so if you're able to reach that, then good, you can invest a little bit more, but just make sure that you have a lot of data. So for example, one of these brands that I was working with, they did make a pretty big shift from that 5% to 50%, but that they haven't been doing that for long enough to know if those are high value subscriptions, because inevitably you have people who come in, will subscribe because you're forcing them down that particular conversion pathway. They'll subscribe and then just cancel after the first order. They got their discount and you're not penalizing them for doing it, so you can do it. So just because you got people to subscribe, then now you don't have a lot of data on it, or the data that you have are like the real subscribers from when you were at 5%, like the people who were like legitimately motivated to be subscribers versus the people that you're forcing into the subscription pathway. So translating those those retention numbers to these retention numbers might be a little bit misleading. So for me, when it comes to, especially if you don't have a significant amount of venture funding, you don't have a lot of cash flow, and you are a little bit more in that kind of bootstrapping zone, if you will, I like to just say, just go first order profitable. At least you'll be on the safe side. If you eventually kind of get that data to show like, no, our retention numbers are actually spectacular, then good. But don't make the mistake of assuming that historical retention numbers based on a particular type of individual, a type of purchaser, a particular cohort, a particular acquisition channel is going to be the same. Like if you're acquiring customers through your organic social media because you happen to have a big following, that's not the same as when you start acquiring customers through Facebook ads. So just be conservative is, I guess, what I'd recommend.
So let's talk. So outside of subscription products or skincare, things that are naturally recurring, you've seen a ton of companies. So like how many recurring orders is normal within, like, let's say 12-month span, like a 12-month LTV? Is it like 1? Is it 1.3? Is it 2? Because I'm always surprised
Yeah.
when I see that digit, and so I'm interested to hear what that digit is from you.
It's a good question. I don't know if I'd have the exact number off the top of my head, no, but it's definitely below a 2. I want to say it's like in the 1.3, 1.4 range. Unless you have subscription or skincare beauty where it's like naturally recurring, for most brands, at best you're getting 20% additional LTV out of the a given acquisition cohort.
A small amount to be typical, because then realistically at that recurring, especially after sending all the emails, doing all the stuff, like where's the actual like first purchase profit you mentioned there as conservative? Like if somebody's actually making money on it, that's really conservative. Like realistically, where's the growth here? Like where if the fastest growing brands you're working with are not necessarily first purchase profit, but they're making their bank on second purchase.
Well, the tricky thing is comparing basically these. If you're into the fitness world, it's like comparing natural bodybuilders to the ones who use PEDs, right? If you have venture funding, like you just can't really compare those to the ones that are bootstrapped, because they can acquire brands at a clip that, or at a CAC that just can't. It's not sustainable. So they have this long-term vision for like, okay, we'll just kind of aggressively attack the market rather, acquire all this revenue, and then we'll figure it out later. But for regular brands, you just can't do that, which is why like I don't like to recommend going first order profitable unless you have very strong retention data, because ultimately the problem is that if even the amount of recurring revenue that you can experience is a function of how much you're acquiring a month or two ago. So if your point of view is that, okay, I'm just going to be always first order break even. So if you're first order break even while having $1 million a month of new customer revenue, then your recurring revenue is going to be pretty high because you're just acquiring so many customers. So even if it's 20% recur, that's 200,000. But the problem is that once that comes down to, say, 200K, all of a sudden your returning customer revenue, I mean, it's a leaky bucket. Those people are just going to churn out, and you're not refilling the bucket fast enough. So eventually it's going to be too low to cover your fixed expenses. So that strategy doesn't work anymore. So that's why kind of being able to do a little bit more robust forecasting for new customer revenue and returning customer revenue separately and kind of project how that stuff is going to look down the road helps make better decisions. But that's why the first order break even is a fairly aggressive strategy that I don't typically recommend.
And so another thing is like, around the channel of where you acquired it. You mentioned there social versus paid ad, or like organic social versus paid ads. One that we're seeing a lot of recently is actually stickiness for retention is Amazon. So when people go on subscribe and save, we find that significantly more like a higher retention rate than somebody who's getting billed from waterbottle.com. Like they're like, whatever, go away. They're going to cancel that off my card, or they're going to retract it. Whereas if they see an Amazon charge, like whatever, like it's a couple bucks. What do you find that to be the same? Is that kind of something? Because if you look at that as an LTV, like you're acquiring a customer for a lot more, but you're actually going to make money in the long run.
That's a great question. So I think it's hard to know for sure, because I've worked with brands on this where, for example, they're running subscriptions. So they have their own program on Shopify, and then they have an aggressive subscribe and save program as well. The data on the subscribe and save side is just not good enough to be able to give you like acquisition cohort data to know what the actual LTV is. They just tell you have this many subscribe and savers. I'm like, all right, cool. But I don't know what the net movement is there. So, or how many ins and outs. So it's a little bit harder to determine. However, that being said, I completely agree with you, because at least from an intuitive perspective, I don't really subscribe and save to anything on Amazon, but I just naturally buy so much stuff from Amazon. When I look at my credit card bill, I'm just like, it's just Amazon. Just ignore it.
Yeah, it's just Amazon. Yeah,
you put
the bill away straight away. You don't even
exactly.
Look at
So
it.
it's hard to even know what any particular charge is. You don't really care. If everything's kind of running smoothly, you're good. So certainly from that perspective, it's just very stealthy, let's call it. So it's able to just kind of stay on your credit card. It's a lot less problematic. And the thing about this is kind of maybe my own point of view on this, but I think that the problem with the customers that you acquire from Facebook is that almost by definition, they are customers who are susceptible to advertising. So if you acquire a customer through Meta, that person converted because they saw your ads and they were interested in buying your stuff. Except that now Meta knows that they are a purchaser of your particular category of items, and now every other competitor's ads are going to go to them as well. And so there's no reason not to believe that they won't be susceptible to their ads as well. It's like a person who's not very loyal at the end of the day. And it's a little bit different, I'd say, with the Amazon buyer, because I'd say to some extent they're just kind of they actively go there, try to find a product that they want, they purchase it, and if they're willing to subscribe, the amount of effort that goes into for them to go next time, not only identify that they have a subscription, decide that they don't like the product, then go there and start doing the research to find a better product, that's a very big hurdle for most people. So as long as you don't disappoint them or go out of stock so that the subscribe and save shipment cancels, as long as you don't disappoint them, why would they cancel? But the ad susceptible people are going to constantly be trying to vie for their attention. So those are people that you are much more likely to lose unless you're really doing a spectacular job on the retention side.
Yeah. And then then the other pitfall you have with Amazon is obviously your FBA. And if you're putting all of your stock or 3/4 of your stock in Amazon, you got to sit there with like no stock and hopefully it sells. Maybe, like it's a tough one. It's a tough balance to fight, right?
Exactly, especially because Amazon keeps introducing new fees about like minimum stock level. So you have now low inventory fees and too much inventory fees. So it's just it gets complicated to navigate that whole. So don't get me wrong, I'm not a big fan of Amazon, but it certainly has its uses.
It's definitely cash flow.
So walk me through. Now we started talking about it earlier on, but we're walking into a season where cash reserves are going to start getting depleted, right? Because we're walking into holiday and we're making the inventory orders and we're making, you might be hiring. How do you, sometimes they're fast growing brands that their top line revenue is going up. But because they have to make these other acquisitions, more inventory, more staff, as they're going up, they don't feel the growth, right? Even though the contribution margin is there. How do you coach brands through that? Because they'll go to you and they'll be like, "Hey, like, why is my bank account like at the end of the month not going up?"
Amazing ramen
that you're telling me.
Like, I've had that conversation very frequently where a brand. The simplest way is like, I feel like I should be making more money, but I don't have that much money in the bank. So very common.
Yeah.
So there's two aspects to that, I'd say. The first and most important one is just understand the math behind it. So it's really just understanding your numbers, because at the end of the day, it's not really a mystery. Everything is there. It's in the accounting data. It's in the bookkeeping processes. So we can figure out where the cash went. Everything's recorded. It's just a question of actually doing kind of the categorization or the grunt work to record it and then consuming the data. So it's being financial reports are created, they're presented, you read them, you understand them. So the data's there, you just need to actually put in the effort to understand it. And then from there also make decisions to say, okay, which of these expenses or which of these cash flows are things that are absolutely necessary versus things that I can change or make adjustments to kind of improve the situation that I have or to get the outcomes that I want. So one part of it is that. The second part is that inevitably, if you are planning a somewhat aggressive growth, if you are pursuing certain things, there's a lot of those expenses that even if they're not frivolous, they're just not really top of mind. So you're thinking, okay, well, I need to make sure I have enough inventory cash. I got my revenue coming in. I got my 3PL expenses and my ad expenses. There are a lot more expenses beyond that, but they're just not quite as top of mind for people. Like, people don't think about the fact, like, oh yeah, I got to pay my accountant $10,000 for filing my taxes. Like, you pay it once a year, so you don't really think about it. So there are those kind of aspects to keep in mind, which is why it's helpful that, and like we mentioned, you can do your best forecasting, it'll never be perfect. So it's always good to also have these buffers, which is why there is opportunities to kind of work with all these lending partners that either give you revenue-based financing or asset-based lending, or if you have a good relationship with your bank, you can get a revolving line of credit. So just having those opportunities to help them mitigate sort of fluctuations on the working capital side can also help. But that's kind of a backup. And you can actively plan to use it if it makes sense. Like, you know you're going to do really well for Black Friday, so you're willing to go into debt to acquire the inventory, because if you don't, then there's a lot of potential profits you'll miss out on. So there are opportunities to use that strategically, but at the end of the day, a lot of it just really comes down to understanding your numbers, because it's not a mystery. It's there, just most people don't look.
Yeah, they choose not to look, and then they get hit with the face with it. It's like, what happened?
But how do you coach them emotionally through it, right? Because, like, you can show them the numbers, but they're still pissed, right? There are a lot of people that are still pissed.
Yeah, no, that's a great question. So fortunately, at least as an accountant, people don't usually get mad at us. They don't shoot the messenger too often, but some people can be emotional. But so to me, it's really a function of, well, it's our job essentially to make sure that we package the data in a way that is easy for them to consume. One issue that I think a lot of accountants have is that they feel so comfortable with accounting data, they feel so comfortable with spreadsheets and tables that for them it's like, well, yeah, the data's here, take it under, like it's so clear there, and they don't necessarily appreciate that for a lot of people. It's not as easy to consume information packaged in that particular way, and so they focus more about the actual accuracy of the numbers, which is important, rather than whether or not the information is consumable by the party that they're giving it to, and also whether or not they're going to use that information to make good strategic decisions. So for me, again, having worked a lot on the other side, like the non-accounting side of the world, and having worked with a lot of founders, I make it a point that a lot of the data that we provide to our clients is packaged in a way that's a lot easier for them to consume and understand. And ideally, giving them advice that also takes into consideration the non-accounting side of things, because that's the issue. A lot of founders, some founders most founders don't get the accounting side, and some founders don't really understand the marketing side either. And they'll get advice from their accountant, they'll get advice from their marketing agency, and those two don't really, they're complete polar opposites in terms of personalities, the way they think about things, the way they see the business. Yeah. And so then it's the founder's responsibility to kind of synthesize strategy from these opposing advices, where that guy's like, yeah, maybe you should spend less on Meta. That seems like a very big expense. And that guy's like, we need to spend more on Meta. We're making such a great ROAS. So it's hard for them to synthesize strategy from that. And at best, you do have a founder that at least understands the marketing side, but oftentimes the finance is still a little bit of an arm's length away, just because, again, that's not why people get into founding brands. So really, the more we can make that information digestible and easy for them to consume, the better they're able to achieve the outcomes. Because at the end of the day, I don't care about doing accounting for the sake of accounting.
The calmer they're going to feel, the easier it's going to go, and the better decisions they make. It's clearer. Listen, Abir, that was amazing. There's so much stuff. There's so much information.
Wait, hold on. Can I ask one more question?
Please do. I'm as long as Abir is good to stay, I'm good to go.
So I have one substantive question, one more funnier question. I'm going to ask the funnier one first.
Sure.
Hypothetically speaking, not to say I'm going to do it, but if I wanted to expense a Ferrari or a very fancy sports car, how would I do it in actual steps?
So it's a good question. I'm probably not the best person to answer that, because I'm a CFO guy. So I'm the type of CPA that focuses more on what goes on inside a company. So the tax side, that's my co-founders. They understand the tax side. I don't even do my own taxes. They do my taxes, because that's everything post money. What I will allude to, without actually saying what can be done, is that they're very good at figuring out the available mechanisms that are there for you to take advantage of whatever tax rules exist, and the leniency that also exists in the way tax auditors look at things. I'm not going to snitch on myself any more than that.
What is the wildest thing that you've ever seen expensed?
Oh, wow. Okay, so I used to work with this one guy who is a fairly well-known guru. One of those like classic Instagram gurus who keeps talking about e-commerce, automation, and stuff like that, selling courses, pre-built stuff. Exactly, dollar bills on it, almost to the cringy level of it, where it's like just fancy cars, chains, and everything. So we were working with him at a certain point. This is before I realized how sketchy he was. We were working with him, and we started working on kind of like all just getting his books in order, because it was kind of total chaos. And I think the worst one was where he took a whole bunch of the money that was coming in from these people who were buying the stores that were pretty much paying up front, and he was just going to these like massive parties at different events, spending $5-10K at a restaurant, that kind of thing. Even some worse things I just won't get into, but let's go with those ones. 5-10K at a restaurant, for example. And he's like, oh yeah, I was just taking clients out, and I'm not the tax guy. I'm just trying to get his books in order. So I'm like, okay, if you say so. You're taking clients out. That's for your tax guy to decide whether or not he's comfortable with that. But eventually I dropped the client. I was like, yeah, this is way too shady. So I can't.
That's shady as hell. That sounds horrendous.
So now on to my more practical question. So revolving lines of credit, right? So this is a tool that a lot of people people hear about. A lot of people, they don't use it, right? And they might take a Shopify loan, or they might take a Stripe loan. And those are smaller loans, right? 50K, 20K, whatever. When someone actually needs a revolving line of credit, like we're talking, $250,000, a couple million, right? Really a couple million. What is the best way you've seen people actually go about getting that revolver?
A lot of times it comes down to the relationship that you have with the bank. being able to get those very large amounts is not that easy, especially if you have a relatively new and somewhat volatile business. And the thing is that oftentimes banks will kind of make somewhat subjective decisions with respect to these things based on how much data they have and how much familiarity they have with that industry. So if you're working with a local bank, for example, that mostly deals with, plumbers and mechanics and some real estate purchases where there are maybe more tangible assets that can be there that they can feel comfortable to have as collateral, it's a little bit difficult for them to understand, like, what is this business? You're just like on the internet and you need $1 million or hundreds of thousands of dollars. Yeah. And it's like, what do you even have? Like, what if I can't get my money back? Where does it go? There's less for them to be able to take advantage of. If you have a lot of inventory, that can kind of help. But generally, e-commerce businesses are asset light by design, and that's one of their strengths. But that also makes it a little bit riskier from the perspective of the bank. So to a certain extent, it comes down to having a good relationship with the bank that you're working with, being able to show a good history of actual like cash flows happening. So if you're constantly have an empty bank account, that's not great. So showing that you have that cash constantly coming in can make them feel a little bit better. And on top of that, being able to also, I guess, you set up a credit profile for the business that you have. So work with Dun & Bradstreet or whatever to set up your credit profile so that when they want to be able to check on the business, they can also see that you have these various kind of credit lines and instruments that have been established for the business that give credibility to the business's ability to kind of pay it back. Also, in many cases, you might have to put up a personal guarantee. So don't neglect the importance of having a good credit score yourself as a person, because sometimes you do have to give that personal guarantee, and it's not ideal, but sometimes that's what has to be done, and especially for newer businesses. So if you have personally been financially responsible, you have a good credit score, then that can also help.
Okay, cool.
Makes a ton of sense. Makes a ton of sense. It's a tough one because we see businesses all the time. They're selling, they're getting a good CAC, and everything's working. LTV might not be as good as they were expecting, and then they're trying to find this credit, and it's just it's a nightmare situation for them because they're trying to float this business that's not really gonna go anywhere because they keep I guess they're making too many orders. The order's too big, or the order's not big enough, and they're not getting the benefit of the discounts, so they're not selling for high enough.
That's the key thing. You should try to get that line of credit when you look the sexiest. So when you're at your best and you look really good and you don't need it, that's when you ask for it, because that's when you'll get it. And you don't have to, it won't cost you. I mean, you'll have some small administration fee to have it available, but you have it when you look your best. And so they'll feel that you're less risky, they'll give it to you, and then you can use it when you need to. But if you only try to get the line of credit when you absolutely need it and your business is not as healthy, it becomes a lot harder.
Exactly, yeah. So one last question for me there, I suppose, is kind of, we talk to a lot of founders as they grow, they kind of go, oh, I want to exit. I want to get out of here. Do you obviously do a lot of work in terms of helping founders prep for exits, or even do you do work on the other side where you look at businesses and go, hey, this is not, this is or a good, or not a bad idea in terms of buying this business? Do you actually do some due diligence on that side?
A little bit of both.
Okay. And what, in terms of the key things as you're starting to scale, what are the pictures you want to start painting as a founder? Like, what do you need to be having in place? Cash in the bank is nice. Good contribution margin is lovely. What are the kind of key things that you say to a founder? Hey, look, you should be thinking about these numbers as you're starting to scale.
That's a great question. So I'd say that maybe two broad categories of things that are very important. Number one is very robust and accurate historical data. So anybody who's going to invest in you, they're going to be looking primarily at two things. How have you done, and what do you think you're going to do in the future? Like, those are the kind of two sides of things. And how you've done in the past is a function of what data you can actually show to them to prove how your historical performance has been. What isn't great is if they come in and they want to look at your historical data and it's a total mess. And oftentimes I speak with founders where they're almost in a panicky situation, like, hey, I'm talking to this investor, my books are a mess, and I don't want them to see it. So we have to like quickly clean things up to get it to a state where it's presentable. So on the one hand, I mean, let's be clear, the value of having good historical data to understand how your business goes is important, independent of being able to show it to an investor. But it's very hard to convince an investor that you're sophisticated or actually as healthy as you are, or that things are going well, if you don't have data to present to them, or if they think it's just a complete mess, because it just looks unprofessional at the end of the day. So the historical side is the one big chunk, so that you can show with confidence how you have been doing. And the second side is to be able to present forecasts that are somewhat reliable. part of that comes from the developing the habit and the I guess the practice of forecasting over time. Like if you're good at it, you've been doing it for a while, you keep making tweaks and improving your ability to set out good projections, then you can be a little more confident when you present them, and you can also back them up when they start inevitably trying to poke holes everywhere and asking questions about them.
Yeah.
And the second aspect is that they're going to be concerned about the longevity of the brand or the potential for it to grow. So the more that you're able to draw clear indications or clear links between certain activities and how that has led to growth, and basically use that as an explanation for how you'll continue growing, the better it is. So if you happen to, for example, go on Shark Tank, get that big spike, and then come back down, and you say like, oh yeah, my revenue's going to keep going in that particular direction. It's like, well, no, you're not going to go on Shark Tank every 6 months. So there's obviously something where how good is your meta strategy? Do you have a very strong influencer strategy? Do you have some sort of approach that's working that is something we can be reasonably confident in when we're projecting out? But the big thing oftentimes for that is the revenue side again. Like the biggest thing they focus on is revenue, just from the perspective of the fact that it is the most questionable aspect. Not to say that they're going to invest just because you have great revenue, but if you have zero profit or your COGS are terrible, your margins are trash, they're still going to want to invest. Like ultimately cash flow matters to them. But the revenue is the hardest question to answer. Like I said, everything else is mostly math.
Makes sense. Makes a ton of man. This was awesome. Thank you so much. This, like, I'm staying quiet. Usually, I'm talking a lot. I'm staying quiet because I'm just listening and absorbing everything you're saying. It's fantastic. So
I also talk a lot, so sorry.
No. You and I could be good friends if you talk a lot, and I'll just listen because I need somebody to listen.
All right, guys, that's it for us this week. We had an amazing show. We learned about contribution margin, how to do back of the napkin math, the wildest things that we have seen expensed. I'm Edwin.
I'm Trish.
I'm Abir.
We'll see you next time.